Good evening, everyone, and welcome to the Power of Passive Investing. We're thrilled to have everyone with us today. I hope everyone had a restful holiday time with your friends and family. This is our first webinar in 2024, and we're beyond thrilled to have an amazing guest today, Aleksey Chernobelskiy. He's gonna talk and answer your questions and our questions about one of the hottest topics, I believe, red flags for passive real estate investors. We'll start with giving Aleksey the floor and having him give us his brief bio so you folks can hear about his background and his experience and understand where he's coming from. So without further ado, Aleksey, welcome, Happy New Year, and please share a little bit about yourself with us.
Yeah, thanks. I don't know if I can see everyone else. Maybe do I just listen to everyone? But it's only you and I, right?
It's you and I. The questions typically come in a Q&A or in a chat, but I monitor that, so I will be reading that
Oh,
too. So yeah, no
oh,
worries.
cool. Okay, yeah, awesome. Well, thank you so much for having me on. Whenever I get on these, I just start with the fact that you and I have spoken once, but we're not affiliated with one another. And I always have to be careful because sometimes people assume that I'm sort of endorsing folks when I'm just speaking to them. Um, so in terms of my background, I come from the institutional world. I've been on a few buy side investing jobs. The most recent one was a public REIT, a real estate investment trust. I led a 20-person team there. Was essentially in charge of the underwriting of any new transaction, and I think but when I was there, we probably underwrote 3-4 billion of real estate, of which we bought decent amount, probably a billion or so a year. Um, I also led the $10 billion portfolio that we had, which was roughly 2,000 properties by the time I left, all across the U.S. And more recently, I left and started something on my own. Have a passion for education. Notice that this GPLP space is particularly opaque. I think when I think of the space, I think of, an engineer or a dentist trying to make sure that they don't lose their money and make some sort of decent return. And they just have no way of figuring out whether what they're looking at in terms of the investment memo is market, reasonable, not, and there's just not that many places to turn. So I advise full-time on existing and future transactions, existing mainly being capital calls or some sort of decision tree necessity. Um, and then the future deals are just, future deals that people are thinking about investing in. And I also write a lot. That's meant to educate people pre-investment and post-investment. Um, yeah, happy to answer any questions. I don't know if you've gotten some stuff or maybe you have some things.
Awesome. Thank you, Aleksey, for that impressive bio. Let's just start off by clearing some things up. You mentioned that you worked for REIT. I don't want to make assumptions, so why don't you go ahead and explain to folks the difference between REIT and a private real estate fund?
Yeah, it's a really good question. So a REIT is a public real estate fund. Uh, it happens to be that there could be private REITs as well, but most REITs are public. In other words, just like you can buy a share of a stock of Google or Microsoft or name your favorite company, you can also buy a piece in a real estate portfolio of a company that is public through a REIT. And I actually think that it's a decent way of getting exposure to real estate. I have a whole article on sort of like comparing and contrasting public REITs to the private securitization world. I think both have pros and cons, and um, at least as far as I'm concerned, I think both should be part of like a healthy, diversified portfolio, not just one.
Uh, are the minimums different and as far as how much investors can invest, or are they pretty much within the same range?
So good question. On the public side, the minimum, unless you do fractional shares, which, many like folks like companies like Robinhood, for example, allows, you can like own a portion of a share potentially. But it's really subject to whatever the share price is. So you can buy one share at $500 or $100. Generally speaking, the price per share is a lot less than you would have to invest in a private syndication. Um, as far as minimums in a private syndication, we can certainly talk about that. I think it's a bit of a topic on its own right. I think um, people have to keep in mind that if they're investing in a public name, there is sort of governance already in place. There's audits of the financials. A lot is going on day to day to make sure that the company can be public and traded. Whereas a private name is kind of like typically in the lower middle market, like less sophisticated potentially, a little bit more due diligence is necessary. So generally, I say that if you're investing less than 25,000, you should probably not be investing in syndications.
So, Alexa, the way you're alluding, it sounds like to a degree you're favoring REITs simply because they are audited and have to go through a lot more rigorous requirements from the government versus private syndications, which are essentially SEC regulated. Is that so, or is there more to it?
So I don't know if I would say that I favor them. I think if you ask me for the average, and if an average investor is starting, um, I would say it's much safer to go into a REIT than go into a syndication. There's a whole conversation to be had about governance and risk of a specific asset on a syndication versus a REIT, which is like a more diversified play, right? But what I would sort of like to summarize, at least for now, if you don't have the time and the energy to really invest in understanding a syndication and its risks, it really takes effort. You'd be surprised how many times like clients call me and they're just like, "Hey, I just want to put my money somewhere, passive investing. Um, tell me where to put it." And my first question is like, "Do you have time to look at the deck and think about it?" If the answer is no, don't invest. Just don't. Like, go put your money in an index fund, a REIT, whatever. Like, that's already a whole different discussion.
Mhm.
But uh, the notion that you can take money and put it into any syndication and have it do well is, I mean, it's extremely dangerous. Like, you can lose money and it takes forever to get it back. Um, which is a whole other article I wrote about. But yeah.
Yeah, we're definitely going through the times where um, some syndications, without giving the numbers, unless you have a percentage, are experiencing challenges because of the environment and because of the cycle we are in. So you mentioned earlier capital calls. Let's talk a little bit about capital calls, what they are, how they come up, and are there different types of capital calls?
Yeah, let's start with the last one. So I would say that there are two types of capital calls, more broadly, ones that are expected and ones that are not expected, right? So for example, if you fund into a deal that is a development, it might be a development that is funded through separate capital calls. So like it's $100 million development, in its first phase, it needs 25 million. In its second phase, you need another 25, and so on. So like a few months go by and the GP, my general partner, might reach out and say, hey, we need more money. Can you wire us money? So that's an example of an expected capital call. And that is generally not the topic of discussion in today's news. The news that the newsworthy, so to speak,
Yeah.
articles are, yeah, sorry, go ahead.
Sorry to interrupt you, but I just want to level set, make sure that our audience understands it. So when you say it's expected, meaning when investors were planning to invest in this syndication, the GP told them that there will be multiple phases approach, and at first we'll have you invest this much, and at the later phases we'll do more
Yes.
capital calls and you'll invest more, right?
Exactly. So, and that's common. It's less common, I would say, in the syndication world, but it happens because, like, if you expect the project to take 2 years, why call all of the capital immediately and just have it sit, not being used, right? Um, Now going back to the other question of capital calls in general, typically the capital calls of today are the unexpected ones. In other words, let's say I put $100,000 into a syndication. The intent of that capital raise, at the forefront was that we will not need any more capital. In other words, the deal is fully capitalized between equity and debt. The lender came in, we came in with our equity, and there's not going to be any, there's not a need for any more help. Um, and and all of a sudden, a few months go by, a year goes by, and all of a sudden I get an email saying, hey, I need more money. So that's an unexpected capital call. And that's one that you should, you know, think about very carefully before reinvesting. Um, I think, let me just pause there. Maybe there's questions from the crowd. I think there's sort of like two separate routes that I can go on that topic alone, but let me just pause.
So let's take the route where you said you have to think whether you want to add additional money as per this unexpected capital call. Let's
Yeah.
take it through.
Okay. So as far as unexpected capital calls go, I would say those are made in two different types. Okay. So one of them is where the deal is going. I think in all cases, the deal is not going according to plan. Okay. But there's two camps of not going according to plan. In one case, it's really bad, and you're essentially just trying to save the deal. Um, in another case, things are generally actually pretty fine. And you just ran out of money. Let's say the construction went a little bit over budget by 10%, and you're almost done with the construction, and you just need to finish up, right? So in such a case, I think that's an easier capital call to sort of like wrap your head around. The vast majority of the capital calls that are happening now are not in that camp. They're in the camp of things are pretty bad, and in many cases, the LPs that reach out to me say, hey, like I invested $1 million into this syndication. I just got an email about a capital call. I don't really know what that means. And my first question to them always is, do you know whether your existing position is impaired? In other words, your $1 million that you invested 2 years ago or a year ago, how much is it worth today? Typically, the answer is like, what do you mean? It's $1 million, or like $1 million plus the accrued preferred returns. And unfortunately, that's many times not the case, right? Sometimes it's worth half of the original position, sometimes even worse. So there's a lot of things to kind of think about, but at the end of the day, if you are investing again, that is an investment decision. I think it's an independent investment decision relative to the first one that you made when you originally invested. And you should be thinking about it that way. Like if someone came to you today and your only opportunity was investing in the capital call and you haven't looked at this deal ever in your life, um, what questions would you ask? And would you invest? Right? It shouldn't be that different. just, there's sort of like a sunk cost fallacy that goes into play. Yeah, let me stop.
Thank you for that clarification. So let's play along a little bit with this scenario. Someone had a capital call in a situation where the project is distressed and investors are at a loss, and let's say a portion of investors have decided not to contribute. So obviously for the deal to stay alive, to stay afloat, they need to find the capital. So the GP in this case would probably, if they didn't get enough funding from investors through the capital goal, they go to the external sources, right? And in this cases, the funding they would get would be, would you say this funding would be in a preferred position, or is it also always in a preferred position, a first position, whatever you want to call it, over the existing investors? And what should investors' reaction to this be?
Yeah, great question. So I'll answer in a few ways. So to directly answer your question, capital can be raised from many people, right? It can be raised from the existing equity base, so the existing LPs. It could be raised from new LPs, right? That hopefully know what's going on and they're sort of like not blind to the reality. Although that certainly applies to existing LPs as well. And to your point, if there's not enough capital that is raised, the GP certainly can go out to the external world, so to speak, and get some sort of alternative financing, which would include a pref, right? Which is, for the folks listening, just it's essentially a position that sits between the senior debt, like the main lender, and then the equity that would include the LP equity. In other words, it is a position that is not as senior as the loan, the original loan, but is senior to, i.e. more senior than your LP position. So on the one hand, that's bad because there's sort of like this capital sitting in front of you that needs to get paid, and typically it comes with like 15-ish% interest, sometimes more, sometimes less, but it's not cheap. But on the other hand, that capital didn't come from you, and that's important to think about. In other words, I have a whole article on this also with the model, but when you are faced with a capital call decision, at the end of the day, the question is, does investing additional dollars help me make a marginal return on those dollars, but also on the original dollars? Um, and from my advisory work, at least, I've rarely seen the case. It happens, but I've rarely seen the case where like it actually makes sense. Because, for instance, one of the questions is like, how do you know that the capital call is going to be enough? How do you know other capital calls are going to come up in 6 months? Like I trusted you in the beginning to fully fund this project, and that didn't work out. So now I'm contributing another 500 grand from my million. And like, help me trust you again. You know what I mean? So I think that's important to think about in that context too. So sometimes other people's money is good. Like it's okay to say no. It's okay to ask questions. I would say just not just while we're on this topic, not just okay. I'm actually in the middle of writing a really long article about all the questions that you should ask a GP before investing for the first time. And I can't tell you how many times I hear LPs like being nervous to ask a question. Like maybe they'll get upset at me, maybe they're going to take the investment opportunity away from me. Like, okay, so let it be. There's plenty of other things to invest in. I always say always like err to the side of asking more questions rather than not understanding something. Um, plenty of things to invest in.
Yep, excellent point. Would you say that if the money came from outside, would it dilute the existing investor's position?
Typically not investing in a capital call does have a dilutionary impact, yes. But the next question I'm sure you're thinking of is, does it matter? In other words, even if I get diluted, it might be better off not to invest, right? And by the way, this is sort of like a pretty common scare tactic. I hate to use that word, but it is what it is. Like I see capital call emails from GPs that are shown to me by LPs that essentially go like this. Like the first part is, hey, everything is going great. And then the second part is, but we need some money. The third part is we we have a plan. We're not ready to show it to you yet, but we will show it to you soon. And then the fourth part is like you have until Friday to wire the cash. And if you don't, you're gonna get diluted. So LPs call me after getting something like that, and they're just like freaking out. Like, what am I supposed to do? If I don't invest now, I'm gonna get diluted, and like I can't let my other money go to waste. And I can't be insensitive to the emotions of sort of like um not being certain about getting that originally money back. But that doesn't impact the fact that you need some questions answered in order to make another investment decision, because a capital call is another investment decision.
Absolutely. Okay. Great answer. Let me read the question from the audience. It's a bit long, but
Yeah, sure.
so you can follow along. So 2 questions about the current situation with liquidity challenges and funds. Some sponsors are raising money for preferred equity funds to lend to others with liquidity problems. How can I underwrite that in terms of whether the project that will receive a loan is salvageable or it might not be a good credit risk?
Um, it really depends what this person means. In other words, is this from the perspective of the LP investing in such a fund? Or oh, there you go. Hi, Donna. Maybe you
Yeah,
can
hi.
clarify. Yeah, I think it depends if you mean like if you're thinking about investing in a fund that will sort of like fund those pref investments, or you are considering making those pref investments yourself.
I would be a limited partner in these. I've seen several announcements coming through that say kind of the general gist is, well, you may have seen in the news a lot of distressed properties, so we're setting up a fund so that we can loan because they'll pay a really high interest rate to salvage their liquidity problems. And then I don't know how to tell, well, that I'm not really sure if that's a good idea. And you'd have to really trust the GPs to have a really good take on like you were just walking through, whether putting new money into that project is even gonna be enough to keep it afloat.
Yes, and it goes like worlds beyond that. And just to give you one example, so like a project might not go according to plan, but the pref equity needs to have the ability to step in and essentially like kick out the existing GP. Meaning there needs to be a mechanism for the pref to say, hey, like you guys are not doing this right. And at some point they need to be able to like physically, so to speak, get the keys to the building and step in, because otherwise your pref investment is also going to disappear, right? And so I think the easiest um way to answer your question, I mean, let me ask you this. If if I am a GP and I come to you and say, "Hi, Donna, um, I am going to invest in multifamily buildings." it's great, blah, 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 blah. So I hope one of the first few questions to me will be, how many multifamily buildings have you invested in? Right? Fair question.
Mhm.
Like, so I think there's no difference here. In other words, people are catching this wave, and there's certainly like a marketing component to this. So like you should be aware of that. It's like cool to be like saving properties. It has higher interest rates, but as you've alluded to, that comes at a pretty big risk. And so I think the first question is, how many pref equity investments have you made to date, right? And I think what you'll find, I never name names, but what you'll find is many people haven't been in the pref equity seat. Like they've been an owner, but being in the pref equity seat is sort of like a hybrid position between like an owner and a lender, and or you're really like sort of like a distressed player. And you're hoping that you just get paid, but if you don't pay, you know, if the borrower slash partner doesn't pay, so you got to be able to step in and do the work to restabilize the property to get your money out.
That's a great tip, right? The same questions as normal. Well, what's your track record? How are we going to be able to work together? You know, yeah, I love that.
Yeah, and I
And
think what you'll hear what you'll hear often is like, well, like we've acquired 100 million of multifamily buildings. And what you should say, I'm pretty unfiltered. What you should say is, that's not what I asked you. I mean, like, I didn't ask you how many buildings you own. I asked you how many pref equity investments you have. Those are two
That's right.
different things. Um, and you know, experience matters, which is, you know, that's a whole topic in its own. But hopefully that helps.
That really helped. Yeah, and I do try to know in my mind, I mean, as reading through in the first place, going back to your other points before about what happens in a capital call, whether you only get diluted or do you actually risk just completely losing your investment, which is sometimes how they write the PPMs.
Yep.
And so that's always something I'm looking for in the first place. So hopefully don't put myself in the position where I'm afraid to ask the question of what's going to happen if I don't fund this capital call. I want to know that up front.
Yeah, and you
Okay.
and I again, I'm writing this article as we speak. I'm probably going to publish it tonight. But like, um, please, if there's one thing you remember from this entire call, it should be that you should never be afraid to ask questions. Like, I know this is like, you know, it sounds like you're in school or whatever, but like, it's your money, right? Like, this is like so basic, but I hear this every single day. People are like, well, like I need to put my money somewhere, and like if I ask one more question, I'll just maybe make them upset. Um, and it's okay if they get upset. In other words, if they get upset, they probably weren't a good investment to start with. Um, and if they don't get upset and they answer your questions in a logical way, that's probably a good sign, right? So it's sort of like it's a pretty nice elimination process.
Right. It's like an audition process. When you look at the PPM, you write some questions, you talk to them about your question, and if they don't
Right.
treat you right, then you can miss them.
Exactly. Exactly. Yeah.
You want me to ask the second half, Alina, or you want to?
Please, Donna, go ahead.
Okay. So the second half of my question was the same kind of theme that you were developing before, is that I do see now some opportunities to invest in funds. So it's a new fund that's going to be for multifamily from the same multifamily operators that I've seen in the past. And they might be good operators for multifamily. Now they're collecting for a fund, which they say they want to have money in hand in case good deals show up, because we're all expecting some good deals to show up soon, right? But I often wonder when I see that is maybe they're just collecting funds because they've got some distressed deals they need to cover. And how would I really be able to validate the use of the money once it's in the fund?
Okay, let's take it one piece by piece. There's three pillars that I recommend to people when they're looking at any deal. The first of them is execution, which includes many points, but one of them is just like basic trust. right? In other words, do they seem, and this isn't like, are they famous? That's a whole other thing that I speak about. Like, it's not about how many followers they have or Snapchats or Instagram or whatever is famous nowadays, or YouTube videos, right? It's not what I mean. Again, this is so basic, but it's not like what kind of car they drive, or how nice they were to you. It's about like having actual conversations around data, right? And actual deals and how they react to like uh questioning. It's really that simple. Like if someone is acting uncomfortable, that's probably not a good sign. Now the reason why I mentioned trust in the context of what you're saying is, I mean, you are essentially, which by the way, it's very good that that you're doing this. I think any investor should have like a healthy dose of skepticism. Um, I think there's a difference between like fraud and skepticism, right? So like what you're describing is they are raising a fund that is going to a fund, and the fund per like legal documents that you would sign has a mandate. Uh, I will assume, I think it's fair to assume that the fund's mandate does not allow them to put money into their own deals. Like that would be a massive conflict of interest, right? Meaning you can't sort of like take money from one investor and help yourself um without getting in trouble. Now here's the crazy part, Donna. Like, does that happen? I guarantee you it happens, right? Like, but does it happen with generally trustworthy people? A lot less often, right? That's where it becomes difficult. Now, um, let's sort of jump over the trust barrier. Let's assume that like you actually believe that the fund is legitimate. They're not going to sort of like backdoor invest in their own properties to save them without telling you or against the mandate. Um, there's a larger question here, I think, which is should you invest in funds? And I think that's a topic in its own right because a fund is pretty blind, right? Like you need to have even more trust in a GP to give them money into a blind pool compared to a syndication, right? For a syndication for a specific asset, right? So like all else equal, if I came to you and said, "Hey, Donna, I'm thinking about buying this $10 million property. Like, here's the entire underwriting, my deck, here's my assumptions, blah blah blah. Like, do you want to invest?" Right? If then I come to you and say, "Donna, like I changed my mind. Instead of buying this property, I'm just gonna get $100 million pool and I'm going to invest in a bunch of properties that are similar to the one that I showed you." So immediately, you're sort of like level of due diligence and level of trust needs to go much higher, right? Because like you have no idea what I'm investing in, right? There's a mandate, and assuming you trust the fiduciary, the GP, presumably they'll follow it, but it's still entirely up to them, right? So like it's a different game, it's a I shouldn't say different, it's a related but different game, and so I think there's definitely something to be said from the GP side to say, hey, it's much better to have funds available when properties come up. I can also tell you, like coming from the REIT world, the similarity to the fund world is you can be a lot more competitive when buying properties because you don't need to wait to syndicate the money. Like it's available and ready. So there's a lot of benefits to a GP to having a fund or capital available. But from the investors, from the LP investors' perspective, that is a riskier investment.
Donna, does that answer your question, or do you have a follow-up?
That gave me a lot of good talking points. Also to remind me, well then ask that specific question if that's my question. Right, to the GPs who send me an email. Thanks.
Yeah, for sure.
And Alexei, to your earlier point, I see that you keep reinforcing the fact that each investor should not be shy asking GPs any questions, absolutely any questions they have, because the more they ask, the better they will understand the investment, and it'll get easier for them to make a more informed decision on that investment, essentially.
Yeah, and I think going in, generally, like in the institutional world, I probably looked at somewhere between 7 to 10 deals for every deal that we ended up buying. Um, and I think it shouldn't be so different for an LP. In other words, when you get your first deal or your fifth deal, like the expectation shouldn't be, oh man, like it's this or nothing. What's gonna happen if I ask one more question? It's just this. So okay, so like go through a typical investment process, ask the right questions, learn to ask the right questions. If they don't answer you because you've asked too many questions, okay, like there's plenty of other GPs out there. Now I will say, look, I think there's like some questions sort of like carry more sensitivity than others. But that doesn't mean that I mean, if a question has a certain amount of value to you in your investment decision, ask.
So on that note, let's say we have a use case where there is an investor that's new to a particular group, and he or she found this group on their own and does not have any reference or referrals from other people. Is it okay to ask for referrals to speak with some of the existing investors? Is that allowed, or are the GPs allowed to provide someone else's information to speak on their behalf?
I think there's two separate questions there. One is whether it's allowed, and two, which I would argue is more important, is whether it's valuable. So whether it's allowed, um, I mean, I'm not an attorney, but I don't know why it wouldn't be allowed, you know? Um, I think an existing LP might have sort of like confidentiality challenges in terms of like disclosing returns or something like that. But if a GP makes the introduction, presumably they're okay with them discussing them, right? Now let's get to the second question or second point that I made, which is it valuable? And there I mean, this might surprise you, but I would actually say it's probably not valuable. Um, in fact, it is potentially dangerous because the GP, I mean, has their interest in mind, and they're gonna pick someone that got a good return and is happy. Like they're not gonna send you to a referral of someone who's not happy. And by the way, I think the same idea holds when like your uncle shows up with a syndication and says, hey, like I love these guys, they're so nice, like let's invest together. um you know Social proof is helpful, but you should, as much as you can, like avoid it having any impact on your investment decision. It's difficult to do, but you should really like fight against that urge to be like, oh yeah, like someone else did the diligence, someone else is really happy with them, therefore I will be too. Like that's it's a slippery slope.
100%. As far as GPs investing in their own deals, how critical is it, and do you think there is certain minimum or percentage that they absolutely must invest?
You're talking about co-invest?
Yeah, in their own deals.
um Yeah. So I mean, I recommend 5 to 10%. I think I would note two things. What really matters at the end of the day is where the money is coming from. One, we can talk about that in a second.
Let's do that.
Uh,
Because I don't think everyone understands what you mean. I do, but let's talk.
Okay, so I think when you ask, and this this goes into a whole other sort of like can of worms, which is like, how do you ask questions? So for example, you can ask a GP, hey, what are you contributing as the GP? And the answer is, let's say 5%. So you're like, okay, cool, awesome, move on, or like invest or whatever. Um, Another way to ask the same question is, I noticed, I'm just making an example, like I noticed that the deck says that the GP entity is contributing 5%. Is that 5% coming entirely from you personally? Um, and that's a little bit of a sensitive question, but I don't think it's something that you should be scared of asking, because let's say it's not them. And by the way, in the syndication world, especially in the past few years, this has gotten really famous. Like you'll have a GP that found a deal, a co-GP that found a deal, and you'll have another co-GP that is sort of like raising the money, but maybe doesn't have experience, maybe just doesn't have, maybe has like a deep net worth. So what happens at that point is the the money is actually not really aligned with you, right? Like the whole purpose of a co-invest is that the upside should be exciting, right, for both of you, and the downside should be painful for both of you. And if the money did not come from the person, and it was like it came from somewhere else, or sometimes I've seen cases of it even being borrowed, um, that's just not the same. Like it just dilutes the whole purpose of a co-invest as a principle. Um, Now the other aspect that I'll just touch on is sometimes a co-invest will be sort of convoluted with the acquisition fee. So like a GP makes an acquisition fee, and there's reasons for it. Like they do hard work. It's hard to find a good deal, so you deserve an acquisition fee. Typically, that's like 1 to 2%. Um, and and what happens is the 1 to 2% acquisition fee applies to the purchase price, like the whole transaction, as opposed to just equity, right? And the co-invest is just a portion of the equity, right? So if you like run with the percentages and do like some basic envelope math, it turns out to be that there are certain circumstances where the the acquisition fee that is coming from you as an LP might pay the GP's co-invest, um, and then some. So I mean, I've seen some cases where LPs will come to me and be like, "Oh, yeah, this is like really healthy. Like the GP co-invest, there's co-investing, and it's like, well, they're kind of co-investing, but kind of not, because that money is actually coming from you. Um, and that's just important to think about. In other words, how much of a co-invest is there in excess of the acquisition fee? Because and it doesn't mean that the acquisition fee isn't earned. It's just it's not true skin in the game. Is what I would call it.
Absolutely. Thanks for clarifying it. I think these are very, very critical points, and I wanted our audience to fully grasp that. Before I proceed with the rest of the questions, Aleksey, I didn't want to forget, if our audience, people that are listening live, or folks that are going to be viewing the recording, it's going to be posted on YouTube and distributed to our distribution list. If they want to reach out to you, what is the best way to reach out, or to what are the best places to find you?
Sure, I'm pretty active on LinkedIn and Twitter. I mean, pretty easy to find my name. And then I write twice a week at lplessons.substack.com as well, which um I mean, I guess I'm biased, but I really recommend it to anyone. Every week I like send out new ideas that are in depth, and also send out sort of like anything that I find interesting and relevant to the LP world. Oh yeah, thank you for putting it in.
Absolutely. I want folks to be able to find you, so I always type it in the notes. Awesome. Okay, let's continue with the question. So, we talked about alignment of GPs and LPs. Let's talk about the sensitivity analysis and entry and exit cap rates. Would you say it's essential to include sensitivity analysis in the offerings, or is it too confusing? And then the same would apply to entry and exit cap rates. Are they needed? Are they a must, or are they more or less optional for as materials for the investors?
I mean, this is a little bit of a unhinged take, but I think if sensitivity analysis is too complicated or it scares you, you shouldn't be looking at syndications. Meaning it is not yet the time to actually invest in something. That's how I would say it. Meaning you might still be educating yourself and learning from all the things that you're seeing, but the concept, if that concept like overwhelms you, at least from in my humble opinion, like you're not actually ready to invest. So now to answer your actual question, the way that I would phrase it is it's not necessary for the GP to include the sensitivity tables. That's subjective, right? I would prefer for them to be in there, and I always think it's better when they are. But I think it is an objective opinion to say that an LP should ask for them, right? Meaning every single deal has certain catalysts that will make a really big impact on your returns, right? Like, so one of those immediately is sort of like, what are we selling the property at in 5 years or whatever, like, which is the NOI at exit and the cap rate at exit. So like, you should sort of immediately think like, well, what happens if that doesn't occur? Like, how comfortable am I today in those assumptions taking place 5 years from now? And you can never know the future. And if again, this is kind of an unhinged comment, but like if a GP is trying to play macroeconomist when they're speaking to you, and they're making statements that are extremely confident, even with, I'll just give you an example. Like, you're speaking to a GP and they're like, in a nice way, but it's like, haven't you heard that like there's going to be 4 interest rate cuts this year? Like, yeah, that we baked that into our assumptions, so the cap rate went down. It's like, well, again, with all due respect, what I would say to that, I mean, I would probably just get off the phone. But in my head, what I think is, if you're so confident about interest rates moving, you should probably play in the interest rates market. There's many instruments like in the public markets where you can make a lot more money than real estate. Real estate is indirectly impacted by interest rates, right? And so for anyone to make really confident assumptions or statements about these things, I think is what I would call like a pink flag. But by the way, just to be clear, like, I think it's important to be well educated and thoughtful and know the news and have an opinion, but like, it should be an opinion that's kind of loosely held. Like, you're not an economist, and even economists don't know like what's going to happen, right? So and kind of bringing full circle, if you don't know what's going to happen, so how can you not sensitize? I'm sort of like flipping this around on you a little bit, but like, how can you possibly not sensitize the most important variables that have like a drastic impact on returns? As a GP, I would want to know that information, because at some point my promote is worthless, right? So yeah, hopefully that helps.
Absolutely, absolutely. Thank you, Alex. And since we're coming to our end, to be on top of our, I'll ask you one last quick question. Do you think it matters whether the return of capital happens first, or whether there is a return on investment that's happening first.
So the short answer is I have a specific, pretty long article on this, which is called "Don't Budge on Return of Capital." That's the name of it. In my opinion, and this is like a very strong opinion that I think I'll never move from, an LP should never let a GP step into their promote before all the LP capital is returned. I mean, there are very few exceptions to this. I think, like, let's call it 90% of the time, I think this applies. There's exceptions in some cases, but you know, and this is it's really rooted in alignment of interests again, right? Which is that at the front, in the beginning, the LPs put up the majority of the equity, so they have more at stake, right? So how could it not be the case that when a downside occurs, I don't get my money back first before the GP is making money, right? So yeah, hopefully that answered your question.
Yeah, no, it absolutely does. Aleksey, I don't see any more questions from the audience, so on this note, we will wrap
Awesome.
it up. Thank you so much.
Yeah, of course. Thank you so much for having me.
This has been very valuable. I hope everyone enjoyed it. And folks, feel free to reach out to Aleksey on Twitter or LinkedIn. He is more active on Twitter, as he mentioned earlier. And his website is posted in the notes. It's lplessons.substack.com. Feel free to subscribe. And feel free to send us suggestions for future speakers, and if you want to have Aleksey back as well, let us know. We'll bring him back, as I'm sure there will be more questions after you start reading his articles. Thank you very much, everyone. Thank you, Aleksey. Have a good night.
Awesome. Yeah, you too. Thank you, everyone.